and welcome to another edition of Deal Hunter. I'm your co-host, Mitch Flax, founder and CEO of Net Equity Capital. With me, my co-host, Tom Staub. Good to see you, pal.
How you doing?
Man, I'm doing great. We're going to talk about social housing investing today, which is a little unique. Most people haven't heard of it, but my good friends at Edifice Capital have put together a portfolio to go out and acquire social housing, get this, in Ireland of all places. So now we're going global.
Yep. Well, you know what? This deal is interesting in that it's backed by the government. And I have a buddy who owns a different company here in the United States, backed by the US government. And when you have that sort of confidence and security on the exit and cash flow, to me, it relieves a lot of risk in my mind.
I totally agree with you. You're totally right. So here's what the ask is. The ask, these folks are looking to raise $30 million to go out and acquire 25-year contracted cash flow. These properties that from day one are producing cash flow. They are providing investors with a 12% preferred return. They've got some hurdles in there. They're expecting about a 3 to 5 year hold, and they're offering investors some equity on the back end, getting that IRR up to 25% in a 3 to 4 year hold. I think this is one of the best investments that I've heard or have ever seen. The one thing that it does provide limitations to is the check size. They are asking for rather larger check sizes that are in the 7-figure range. Naturally, this makes sense. You know, somebody coming from the investment world, when I look at a deal like this that is backed by the government, it's a quasi-government bond, you know, and if you look at where their treasury is trading, it's not far from where our treasury is trading at. And so anything backed by the government, certainly better than backed by, you know, Joe Smith, working class C person, and trying to fill those apartment units.
So, well, you know, I think when I have these calls with my clients and investors, and I don't know them, the first thing I ask is, well, obviously, what is your scenario today? You know, how old are you and what are you trying to achieve? Right. So someone who's, let's say, in their 30s, maybe even 40s, that is all about growth, not necessarily passive income or cash flow, you know, they could probably find better deals just because the returns are, you know, kind of average from a real estate standpoint. But I think about someone who maybe has made some money and, you know, has a lot of their capital in the stock market, which we know is volatile like crazy today, and needs some security, some very linear cash flow streams. And you think about the risk play here, right? This is a way to diversify your portfolio. And not to get into the depths of it, but, you know, cross asset correlation, right? If you think about this, how it relates to the stock market, it doesn't. If you think about how it relates to the US stock market or the real estate market, really doesn't. This is a separate beast in itself. And for someone who's looking for primarily passive income, I mean, what a fantastic vehicle to make that happen, right? And by the way, the returns, you said it's a 12% clip?
Yeah, it's a 12% preferred.
There you go. So if you're really crafty, you have some tax shelters too to really maximize that. But 12% return on an asset not connected to the US, not connected to the US real estate, it's a really solid play to diversify your portfolio, but also have that linearity of cash flow.
You bring up a great point. I did a lot of portfolio construction in my day. Most of the folks in the financial services industry, the financial advisors, the wealth managers, the RIAs, they're putting together packages of mutual funds.
Yep.
You know, which is fine. You know, you can get it anywhere. You can get it at Bob's house of mutual funds down the street. You know, this is something that you can't get. And that fixed income component, I look at this as more of a fixed income play than something as a real estate play, because this is really a government bond in my eyes.
Yep.
And so I like what you just said, as far as from a risk tolerance and just looking for that diversification in your 100%. Overall portfolio.
Well, let me add two things too. And I, not to crush the time here, but we will want to talk about the sponsors. These are people who are no joke. You know, I deal with some high-end people too in my projects, but these guys are next level, right? So I think it's important, and we'll hit on that for a minute. but also this is a newer asset class to the market. And I say that because the 12% returns are, if this happens again, which it will, this will be a success and they'll have more of these coming to the market. That 12% return will not be the next time around. It will be
probably not going to see that again.
Yeah, it'll be 4 to 6% because of the safety, of the backing. It's testing the market. Therefore, the risk is perceived to be higher, but really it's the same instrument. And so they have to attract, more capital in unique ways, but thereby offering a 12% clip. Same instruments, same structure. It's going to be halved the next time around, which we know it will happen. So
I love what you just said. You're right. It's not a real asset class yet. The writing is on the wall. It's coming. And, typically what we like to do here on Deal Hunter, we like to follow a format, something that, I really stand behind when I'm doing my due diligence. We mentioned it last week. We want to look at the market. We want to look at the property. And then ultimately we finish off with the sponsor in no particular order. But look, if any of those is broken, we're not going to pursue the deal. And so before we even get this deal on our podcast today, before we even start to syndicate it, there is a rigorous due diligence that we all perform to even share it with you, because we do take this very seriously. We're not just sharing any deal that we get. This is something extremely special. I think that most of the takedown of this deal will come from a family office. And that's really kind of what I'm thinking. So, when we look at the market summary, since 2008, the delivery of homes has remained extremely low. Ireland's population is actually the third fastest growing nation in the EU. So they've got a tremendous housing crisis that's really been intensified by the pandemic, which is actually something similar that we've experienced a little bit here. And the government's actually taken initiative to address the problem. So they've really stepped up their game. You've got a lot of mom and pops, very similar to the way that we're doing flips in the US. You've got mom and pops that are doing flips in Ireland, specifically in Dublin, Kerry, and Meath, which is where these acquisitions are going to take place. You've got these folks who are going through the process and getting them contracted, ready, so that when Edifice Capital, who is sponsoring this deal, purchase these assets, they are cash flowing from day one.
Yeah. Well, I think back to the market opportunity, right? We know, I have connections to people who have connections to the Congress and everything else. There's already bills being written to do the exact same thing here in the United States. We know that the wealth gap's widening. People of the rich will stay rich and do fine. People of the lower end will have to figure out ways to find housing. So there's going to be, in fact, Elon just made a mention of this last week. There's going to be subsidized housing here too, on large scale. Sure. And Ireland just got ahead of the game and came to the idea, well, let's build it now, get this housing set up for people who need it, and we'll back the asset.
It's a great point.
Yep.
Let's talk about the property a little bit. Okay. We've all seen the multifamily deals. We've all seen storage deals. I think those are probably very prominent for typical LPs to get involved in. Let's be real here, okay? As somebody who's analyzing an investment, when you are looking at a multifamily, what are the biggest challenges when you've got, a value add to an existing, 40-year-old multifamily unit?
Yeah. Well, I mean, today there's a lot of those, right? With supply chain constraints, subcontractors walking off the job. I mean, it's a plethora, right? And then of course, having a legitimate property management team that controls all of that to ensure that you have high occupancy to get those cash flows.
It's all about occupancy, right? So you've got no worries in this deal about occupancy. The minute that they sign that contract, which they're already acquiring, ready to go, you don't have to worry whether that unit is occupied or not occupied, because you've got a 25-year lease. So you don't have any of those concessions on the back end, right? You don't have any of those lost cost of getting somebody in the unit.
Yeah, and let's double down a little bit. So talk briefly about that 25-year lease with the government, is the government the party that's paying the operator, or how does that all flow?
Yeah, so they're actually housing authorities or local housing boards. Really what they are is they're branches of the Irish government. So ultimately, these local housing authorities are the ones who are actually paying it out, but those are branches of the Irish state. So it's not directly, but it is indirectly an Irish play, an Irish credit play, in my opinion.
So there's essentially the liaison between the people that are renting the house, but they have this budget and funding already happening. So they're paying the operator, and their goal is just to keep it occupied themselves. So it's like this program in itself that's already well funded. That funding is paying the operator. So to your point, 25-year lease locked in, the cash flows are already there. It's so, if Joe Smith leaves the building, that cash flow remains constant. Is that right?
Absolutely. You're right. Exactly. But here's the kicker. So everyone wants to talk about inflation. The best thing about this is that they are inflation linked. Yeah. So I really like that. The other component of this is there is favorable tax treatment in some of the districts in Ireland. Some are completely tax exempt, but some are capped on the taxes. So that does help with forecasting CapEx. Yep. And there are minimal management responsibilities. This is almost like a triple net lease in a way. And so they're able to forecast their CapEx going forward, which I think is critical. There's really going to be no surprises. These guys have done an excellent job in forecasting, the 1 in 100 event scenarios, and they've still backed that in to the debt service, which, let me tell you about this. I can't mention their name, but there is a large German reinsurer providing 94% of the senior debt, $300 million of senior debt. Extremely strict underwriting. And what I love about that, they almost spent 7 figures going and analyzing this deal because it's essentially contracted cash flow for them too. Yeah. Well, they're looking at this as a 25-year deal, and I think they're paying 2.5 points on this. Yeah. So, on a $300 million deal, what difference does it make? They're netting $7.5 million bucks. So.
Yeah, 2 points. This is more or less, I think, a inflation hedge / sort of value for the big boys, right? And 94% leverage, I have never got that in my deals. They obviously are giving that because they see the safety. Correct. That's blatantly obvious. So
$30 million ask, 12% preferred return, 25% IRR. You're looking at a 36 to 48 month hold. You can reach out to me at mflex at netequitycapital.com. The last thing I want to end on here is the sponsor. So this came to me by way of a very close personal connection. He's one of the portfolio managers at Oedipus Capital. They've got a dream team of debt and equity infrastructure portfolio managers. These guys have run money at JP Morgan. They've run money at Jefferies, which is an amazing fixed income house. My good buddy, Curtis Sullivan, ran money at Nuveen Capital. They are another outstanding fixed income shop. So this is a very sophisticated financial real estate and legal expert team. They've partnered with folks that have been on the ground with their eyes and ears that actually identified this arbitrage. Their ultimate goal is to build the largest social housing portfolio and sell this cash flow to one of the larger, Norwegian or Canadian pension funds, which are definitely going to have an appetite for this. So they've already expressed interest. And so this is going to be a short, 36, 48 month hold. I really love the folks who they have on the ground. Okay. They've partnered with a large property manager, Odrim. They actually have tremendous amounts of technology. It's not just a typical property manager that we might be accustomed to here in the US, but they've got to do a lot of things. Remember, this is a government subsidized social housing unit. So there are conditions there. And so they are actually running all of those conditions, the compliance, the remediation, all of these surveys, the inspections that have to take place on an annual basis. So I really love the folks that they have at a high level. These guys know debt. They know infrastructure, and then at a day-to-day management. And it's really not like the property managers that we're going to see here in a traditional multifamily, where really their main goal is to keep occupancy up. They can actually focus on other things.
Yep. I'm with you, man. And we know someone, I won't give a name, that is investing millions of dollars into this project, who has a very extensive background in finance and investing. So, yeah, man, overall, I love it.
I do too. We appreciate you joining us again. Stay tuned to next week, and we hope you learned something. Remember, we create wealth through direct real estate investing. We like to be the smart money. Take care.